3 beliefs, believed by thousands of self-employed workers across the United Kingdom right now. Each one feels completely logical. Each one sounds like common sense. And each one is costing the people who hold it, quietly, invisibly, month after month, real money in penalties, back tax, and interest that compounds while they carry on believing they are fine. I am not going to ease into this. I want to go through each myth directly, show you exactly why it is wrong, show you what HMRC actually does when someone operates under that belief, and tell you what the correct position is. Because in 2026, the gap between what self-employed people believe about tax and what HMRC systems can actually see has never been wider, and the people in the middle of that gap are the ones who end up with the unexpected bills. If you are not subscribed to this channel, please do that now and hit the bell. What I am about to cover is the kind of information that most people only find out about after the letter from HMRC has already arrived. The people watching here find out before. Subscribe and let us get into it. Myth number 1. Cash means invisible. It is one of the oldest and most persistent beliefs in British self-employment. The idea that money paid in cash by a customer, a client, a homeowner handing over an envelope at the end of a job does not quite count the same way as a bank transfer. That HMRC cannot see it. That without a paper trail, there is no trail. That the £3,000 taken for a kitchen refit paid in cash or the £800 garden clearance settled at the Gore simply does not reach HMRC's desk. In 2026, that belief is not just wrong, it is dangerous in a way it has never been before. HMRC operates a data intelligence system called Connect. It cost over £100 million to build, and it cross-references information from dozens of sources simultaneously. Bank accounts, land registry records, DVLA vehicle registrations, companies' house filings, digital
platforms including eBay, Etsy, Vinted, Airbnb, Check-a-Trade, MyBuilder, and Rated People, social media accounts, and anti-money laundering reports filed by banks when unusual cash deposit patterns are detected. Connect does not investigate one person at a time. It runs comparisons across the entire dataset, flagging individuals where the lifestyle, the online presence, the bank activity, or the social footprint does not match what has been declared to HMRC. A plumber in Birmingham whose Facebook business page shows 30 completed kitchen and bathroom jobs this year, whose Check-a-Trade profile carries 15 reviews mentioning cash payments, and who has declared gross turnover of £8,000 on their self-assessment return is not invisible to Connect. They are a flag. And when that flag is raised, what follows is not a letter politely asking for clarification. It is a formal compliance check, an HMRC investigation, which carries the power to go back up to 6 years on unfiled or incorrectly filed returns, and 20 years in cases where deliberate concealment is found. The penalty framework for undeclared income in 2026 is confirmed by HMRC as follows. If you come forward voluntarily before HMRC fines you, the penalty on the unpaid tax sits between 0% and 30% of the tax owed. If HMRC fines you first, through Connect, through a tip-off to their whistleblower line, through bank beta, or through any other route, the penalty rises to between 30% and 70% of the tax owed. For deliberate concealment, penalties reach 100% of the tax owed. That is on top of the original tax, plus interest at 7.75% backdated to when each year's payment was originally due. One plumber documented in a published tax case faced a £15,000 combined bill, tax, interest, and penalty from cash jobs that were never declared. Not because HMRC investigated him at random, because his declared income did not match his visible workload. The correct position is straightforward. All income is
taxable income, regardless of the form in which it was received. Cash, bank transfer, crypto, barter, the legal obligation is the same. Record it, declare it, pay what is owed. The trading allowance means the first £1,000 of gross self-employment income per year is exempt, but above that level, the obligation exists, and HMRC now has the tools to find it, whether or not you tell them. If you have undeclared cash income from previous years, HMRC's voluntary disclosure facility is the most important step you can take right now. Search for Disclose Unpaid Tax on gov.uk. Coming forward before HMRC fines you is the difference between a 0 to 30% penalty and a 30 to 100% penalty on the same underlying debt. Every month that passes after HMRC's data has already been processed makes the voluntary position weaker. The window to come forward is always open, but the benefit of coming forward gets smaller the longer you wait. Myth number 2. If HMRC has not written to me, I do not owe them anything. This is the myth that generates the single largest volume of shock when it finally falls apart. Because on the surface, it seems reasonable. Surely if HMRC wanted something from you, they would tell you. Surely the system works by HMRC identifying what is owed and requesting it. Surely silence means no problem. HMRC published their own response to this belief earlier in 2026. Their exact position, confirmed in official guidance and repeated across their own communications, is this: it is your responsibility to work out whether you need to file a self-assessment tax return. HMRC not contacting you does not mean you are compliant. It means HMRC has not yet identified you. The self-assessment system in the United Kingdom is a self-reporting system. The legal obligation to register, to file, and to pay sits entirely with the individual, not with HMRC. If your gross self-employment income exceeds £1,000 in any tax year, the obligation to register for self-assessment exists from the end of that tax year. The deadline to notify HMRC that you need to file a return for 2025 to 2026 is the 5th of October 2026. That deadline does not wait for a letter to prompt it. It arrives whether or not HMRC has written to you. The consequences of missing the registration deadline and subsequently not filing are automatic and do not require a human decision at HMRC to trigger them. An unfiled return generates an immediate £100 late filing penalty the day after the deadline, regardless of whether any tax is owed. After 3 months, daily penalties of £10 begin accumulating to a maximum of £900. After 6 months, a penalty of 5% of the tax due is applied. After 12 months, a further 5% penalty. A return not filed for 2 full years can carry combined penalties of £1,600 or more before the underlying tax and interest are even calculated, and that tax carries its own interest at 7.75%, backdated to the original payment due date. What makes this myth particularly costly in 2026 is that HMRC's data sharing with banks, pension providers, digital platforms, and the DWP means they are building a picture of individuals' income streams, whether those individuals have filed or not. The absence of a self-assessment return from someone who should be filing is itself a flag in the Connect system. HMRC does not always write to flag people immediately. Sometimes they wait, building the data picture across multiple years, before raising an inquiry that covers not just the current year, but several previous years simultaneously. If you are self-employed and have not filed a self-assessment return, because no one told you to, because your earnings felt too small to matter, because a friend said they never bother, check whether you need to now at gov.uk. The online checker takes 3 minutes. Filing voluntarily, even late, always results in lower combined penalties than being found and required to file under investigation. Let me stop there for a moment. If either of the first 2 myths I have just describes something you have believed, or something you know someone else believes, drop a comment below and tell me. I want to understand what this channel is actually changing for the people watching it, and I want you to know you are not alone. These are the 2 most common misconceptions in UK self-employment, and they are believed by people who are otherwise careful, sensible, and doing the right thing in every other part of their lives. They just have not been told the correct position. Back to the 3rd myth, and this one is the most expensive. Myth number 3. Making tax digital does not apply to me yet, or at all. Since April 2026, a specific group of self-employed workers and landlords in the United Kingdom are no longer filing an annual self-assessment tax return. They are required to file quarterly digital updates, an end-of-period statement, and a final declaration every year through HMRC-approved software. The first quarterly deadline for those in scope was the 7th of August 2026. That date has either passed or is days away as you watch this. The group currently in scope is anyone whose combined gross income from self-employment and property in the 2024 to 2025 tax year exceeded £50,000. Gross income, not profit, not take-home, the total received before any deductions. A sole trader who billed £60,000 and spent £25,000 on legitimate business expenses has a gross income of £60,000 for this purpose, not £35,000. If that figure crossed £50,000, making tax digital for income tax applies to them now. Approximately 860,000 self-employed people and landlords fall into scope for the first phase. The most widely held belief among a very large proportion of them is that the system has been delayed again, as it was in 2024 and again in 2025, and that April 2026 will follow the same pattern. It did not. Senior accountancy bodies across the UK confirmed in early 2026 that the launch proceeded as planned. HMRC's commitment to being a digital-first organization, combined with the successful rollout of making tax digital for VAT since 2022, meant there was no further delay. The first quarterly filing deadline landed on the 7th of August 2026. There is a grace period specifically for the quarterly updates themselves. HMRC confirmed that no financial penalties will be applied for missing quarterly update submissions during the 2026 to 2027 tax year, the first year of mandation, as an adjustment period for affected taxpayers.
That grace period does not extend to the final declaration. The final declaration for 2026 to 2027, due by the 31st of January 2028, carries immediate financial penalties under the new points-based framework if missed. And the grace period for quarterly submissions applies only to this first year. From 2027 to 2028 onwards, quarterly submissions carry penalty points on missed filings, with a £200 financial penalty triggered when points reach the threshold, and further £200 penalties for each subsequent missed submission. The practical steps for anyone in scope who has not yet acted are as follows. First, confirm your gross self-employment and property income for 2024 to 2025 against the £50,000 threshold. Second, select HMRC compatible software. QuickBooks, Xero, Free Agent, and several others are approved, with the full list at gov.uk. Third, register for Making Tax Digital for income tax through your HMRC online account. The quarterly updates cannot be submitted through HMRC's website directly. They require compatible software, and the registration must be in place before submissions can begin. If your gross income in 2024 to 2025 was below £50,000, Making Tax Digital does not apply to you yet, but the threshold drops to £30,000 from April 2027, 11 months from now, bringing a significantly larger number of sole traders and landlords into scope. And it drops again to £20,000 from April 2028, covering the vast majority of anyone with meaningful self-employment income. If you are currently below the £50,000 threshold, now is the time to understand the system before it reaches you, rather than discover it after the threshold drops to your level. The second most common misconception about Making Tax Digital, beyond the belief that it was delayed, is that quarterly updates are for full tax returns. They are not. Each quarterly update requires a summary of income and expenses for the 3-month period. It is not a complete self-assessment calculation. The full reconciliation, allowances, reliefs, and the final tax position happens in the end-of-period statement and final declaration at the year-end. The quarterly updates are simpler than a full return. The software handles the submission format. What they require is that your records are kept digitally and consistently throughout the year, rather than pulled together in January. So here is where the 3 myths sit and what replacing each one with the correct position looks like in practice. Cash income is not invisible. HMRC's Connect system cross-references bank data, online platforms, land registry, DVLA, and social media. The penalty for being found with undeclared income is between 30% and 70% of the tax owed, plus interest at 7.75%, backdated to the original due date. The penalty for coming forward voluntarily before being found is between 0% and 30%. Go to gov.uk and search for Disclose Unpaid Tax if this applies to you. HMRC not writing to you does not mean you have no obligation. The self-assessment system requires you to determine your own obligation and register by the 5th of October following the end of each tax year, where your gross self-employment income exceeds £1,000. The penalty for not filing starts at £100 the day after the deadline, regardless of whether any tax is owed, and rises automatically every month. Use the self-assessment checker at gov.uk to confirm your position. Making Tax Digital for income tax is live from April 2026 for anyone with gross self-employment and property income above £50,000. The first quarterly deadline was the 7th of August 2026. Quarterly penalties are on a grace period for 2026 to 2027 only. The final declaration deadline of the 31st of January 2028 carries immediate penalties. The threshold drops to £30,000 in April 2027. Get compatible software in place now through the approved list at gov.uk. 3 myths, 3 correct positions, and 3 sets of consequences that are entirely avoidable once the correct position is understood. The self-employed workers who are going to receive unexpected letters from HMRC in the next 12 months are not, in the main, people who are deliberately trying to avoid anything. They are people who had an incorrect understanding of how the system works and operated under it in good faith. Good faith is not a defense against automatic penalties, but acting now, while you are still on the correct side of the deadlines, is a complete defense against all of them. Share this with someone who is self-employed and has not thought about any of this recently. The person most likely to need it is the one who would never think to look it up themselves. And subscribe if you are not already here, because the Making Tax Digital threshold drops again in April 2027, and this channel will explain exactly what that means for you before it arrives. I will see you in the next one.